There's a chart that almost every personal finance teacher, every well-meaning parent, every motivational money podcast has shown you at some point. You probably remember it. It starts with a penny. One single penny on day 1. And then it doubles. Every day. For 30 days. By day 10, you've got about $5. Exciting, but not exactly life-changing. By day 20, you're at around $5,000. Now people start leaning forward in their seats. And by day 30, $5,368,709.96. The room always goes quiet at that number. And then whoever is showing you that chart says the same thing they always say. Start early. Be patient. Let time do the work. And you believe them, because the math is real. The chart is real. Compound interest is genuinely one of the most powerful forces in personal finance. Nobody lied to you about the math. But here's what nobody put on that chart. The bank learned compound interest from the same classroom you did. They just chose the other side of the equation. And the uncomfortable truth is, most people spend the first decade or two of their adult lives not on the wealth side of that curve, but on the debt side. And those two sides do not behave the same way. Let me show you what I mean with real numbers, because this is where it gets uncomfortable. The average American carries about $6,000 in credit card debt. Let's say that's you. $6,000, sitting on a card at 22% interest, which is roughly the national average right now. You're making minimum payments, doing what you're supposed to do. And because you've heard the compound interest lesson, you're also putting $100 a month into your 401k. You're being responsible. You're playing the long game. Except you're playing 2 games at once, and only one of them is on your side. That $6,000 in credit card debt is compounding against you every single month. At 22%, in 5 years, that balance has grown significantly, even with minimum payments going out the door. Thousands of dollars in interest have left your account and gone straight to the bank. That money is gone. It will never show up in your investment account. It will never compound into anything for you. Now look at your investment side. $100 a month at an average market return of 7%, after 10 years, gives you roughly $17,000. Which genuinely sounds good. But here's the part the chart skips. Every dollar that went to credit card interest over that same decade was a dollar that could have been invested instead. The debt side didn't just cost you money, it cost you the compounded future value of that money. You weren't just paying interest. You were paying interest on the opportunity. And most people never see that second number. I want you to meet Dave. Dave is 32. He makes decent money, around $70,000 a year. He's not reckless. He doesn't take exotic vacations or buy designer things. He is, by any reasonable measure, a financially responsible adult. He's got a 401k contribution going every paycheck. He has a small emergency fund sitting in a high-yield savings account. He drives a practical car. That car has a payment. 6% interest, 4 years left on the loan. He's got a credit card he uses for the points, and most months he pays it off. But some months, a big expense comes through, or a slow month hits, and the balance carries. It's never outrageous. A few hundred here, 1,000 there. And he's got about 8,000 in student loans at 5.5%. Standard stuff. Fixed rate. He's on the repayment plan. Dave looks at his net worth every few months and genuinely cannot figure out why it isn't growing faster. He's doing the things. He reads the articles. He has the apps. He knows about compound interest, and he will tell you with complete sincerity that he is using it. But here's what Dave hasn't seen yet. He is feeding two compound curves simultaneously. One is building him wealth, slowly, over decades, with market volatility and uncertainty baked in. The other is extracting wealth from him, immediately, guaranteed, every single month, with zero volatility risk. The debt side never has a bad year. The debt side does not care what the S&P 500 did last quarter. Dave thinks he has a wealth-building problem. He actually has a sequencing problem. And those require very different solutions. Here's the name for what Dave is dealing with. I call it the sequence trap. Compound interest was sold to you as a wealth-building tool, and it is. But the version most people encounter first, and longest, is compound interest running as a debt engine. The sequence of which side you land on, and when, shapes almost everything about your financial trajectory over the next 20 years. Here's why the timing matters so much. Investment compounding is slow at the start. The hockey stick curve, where growth really accelerates, doesn't kick in meaningfully until you've got a significant base and serious time working behind you. Most people in their 20s and 30s don't have that yet. The early years of investing feel almost invisible. But debt compounding starts on day one. Full rate. No ramp-up period. No minimum balance required. It is the most efficient version of compound interest that has ever existed, because unlike your investments, it is guaranteed. Your credit card company does not have bad years. Your interest accrues whether markets are up or down, whether you got a raise or took a pay cut, whether you're paying attention or not. The sequence was always stacked against you. And almost nobody in the personal finance world stopped to name that clearly. So what do you actually do with this? The debate you've probably heard is whether to pay off debt first or invest first. It usually gets framed as a pure math problem. If your debt rate is higher than your expected investment return, pay the debt. If your return beats the rate, invest. Clean and logical. But that framing skips over how compound curves actually function in your real life over real time. So here is the question I think you should actually be asking. Which compound curve am I feeding right now, and is it working for me or against me? High-interest consumer debt, anything above 10%, should be treated as the highest returning investment available to you, because that is exactly what eliminating it is. Paying off a 22% credit card is a 22% guaranteed return. No index fund, no ETF, no brokerage account on earth can offer you that. That is not a close call. Below 10%, the math gets more nuanced. Mortgage debt, low-rate student loans, a car loan in the 4 to 6% range, those can realistically coexist with investing. The gap between your debt rate and your expected return is close enough that other factors, like employer match, like psychological momentum, start to matter. But the principle stays the same no matter where you are. You have two compound curves running. You do not get to pretend the debt one doesn't exist because it wasn't on the chart they showed you. The hierarchy is simple: eliminate the guaranteed losses first, then pour everything you have into the guaranteed builder. Here's how I want to leave you with this. Go back to that penny chart. Picture two of them running at the same time. One growing toward 5 million. One compounding silently in the other direction, draining value quietly, consistently, invisibly, every single month. Compound interest is not a lie. It is the most powerful financial force available to an ordinary person, and I mean that without exaggeration. But the lesson you received was incomplete. You were shown the asset side of the equation and told to be patient. Nobody mentioned that the exact same math was already running on the liability side, and that it had a head start on you before you ever opened a brokerage account. The question was never whether compound interest works. It always works. It has never not worked. The only question is, right now, today, are you the one using it, or are you the one it's being used on? Because the answer to that question, more than your salary, more than your stock picks, more than any single financial decision you will ever make, determines which direction your net worth actually moves.